What's up everybody, it's SM, and welcome back to the channel. Today, we're diving into swing trading, capturing gains over days or weeks by reading the market's natural swings. The real edge? Recognizing chart patterns that reveal the battle between buyers and sellers. These patterns act as your roadmap, helping you anticipate market moves, not with certainty, but with a statistical edge. In this video, we'll break down the most reliable chart patterns for swing trading. Media group, claymation montage of various chart patterns forming, claymation sequence of different chart setups appearing at its stock at distribute _ equally, cup and handle, flags, pennants, wedges, and more. With claymation visuals, you'll see exactly how these patterns form and how to use them. Ready to master the art of the swing? Let's jump in. Let's start with the cup and handle, a classic bullish continuation pattern. Picture a teacup. After a rally, the price rounds out a U-shaped bottom, signaling sellers are fading and buyers are regaining control. The handle forms as a brief, shallow pullback, shaking out weak hands before the next move. The ideal entry? When price breaks above the handle's resistance on strong volume. That volume surge is your confirmation. Institutions are piling in. Set your stop loss just below the handle's low to protect your capital. For a target, measure the cup's depth and project it upward from the breakout. Context matters. This pattern works best in established uptrends. Avoid trading it in choppy or down markets. Be patient. Wait for the full pattern and volume confirmation. The cup and handle is powerful because it shows a controlled pause, not panic. When all the pieces align, it's one of the highest probability setups for swing traders. Spot the teacup, wait for the breakout, and ride the next leg up. Remember, trading is about stacking probabilities, not guarantees. Use this pattern as a tool, not a crystal ball. Practice spotting it on charts to build your confidence. The cup and handle. Simple, effective, and a must-know for your trading arsenal. Let's move to the next essential pattern. Now let's talk about reversal patterns. The double top and double bottom. Double top looks like an M. After an uptrend, price hits a high, pulls back, retests the high, but fails to break through. This signals buyers are exhausted. A break below the neckline confirms a trend reversal. Double bottom is the opposite, a W after a downtrend. Price hits a low, bounces, retests the low but holds. When price breaks above the neckline, it signals a new uptrend. Both patterns are about failed attempts. Buyers can't push higher in a double top, sellers can't push lower in a double bottom. The neckline is your trigger. Wait for a decisive break with volume. Set your target by measuring the distance from the peaks or bottoms to the neckline and projecting it from the breakout. These patterns help you avoid buying tops or selling bottoms. They're common and reliable for spotting major turning points. Don't jump in early, wait for confirmation. Use them to exit before a reversal or enter at the start of a new trend. Practice identifying the M and W on charts. Combine with volume for stronger signals. Double tops and bottoms, your early warning system for trend changes. Let's move to the king of reversals. Meet the head and shoulders, the gold standard for spotting trend reversals. It forms three peaks, left shoulder, higher head, and a lower right shoulder. The right shoulder's failure to reach new highs signals fading bullish momentum. Draw a neckline through the two troughs. A break below it confirms the reversal. Enter short on a strong break of the neckline, ideally with a volume spike. The inverse head and shoulders is the bullish twin. Three lows with the head as the lowest. A breakout above the neckline signals a new uptrend. For targets, measure from the head to the neckline and project from the breakout. This pattern tells a clear story. Strength, exhaustion, failed rally, then capitulation. Patience is key. Wait for all three parts and the neckline break. Use this pattern to catch major trend shifts early. Combine with volume and trend context for best results. Head and shoulders reliable, time-tested, and essential for swing traders. Spot it, confirm it, and act decisively. Next, let's look at consolidation patterns. Triangles are classic consolidation patterns, markets pausing before a big move. Three types: symmetrical, neutral, ascending, bullish, and descending, bearish. Symmetrical triangles have converging trend lines. Breakout can go either way, so wait for confirmation. Ascending triangles show higher lows pressing against flat resistance. Bulls are gaining ground. A breakout above resistance signals a strong buy. Descending triangles have lower highs pressing against flat support. Sellers are in control. A breakdown below support is your short signal. Volume usually drops as the triangle forms, then spikes on breakout. Use this as confirmation. Place entries just outside the trend lines after a confirmed breakout. Set targets by measuring the triangle's height and projecting from the breakout. Triangles are everywhere. Learn to spot them for high probability trades. Don't anticipate, react to the breakout. Use triangles to catch explosive moves after periods of quiet. Combine with trend direction for extra edge. Triangles simple, powerful, and a staple for swing traders. Let's check out fast-moving continuation patterns next. Flags and pennants are your go-to for catching quick continuation moves. Both start with a sharp flagpole, an explosive price move on high volume. The flag forms as a brief downward sloping channel, the pennant as a tight mini triangle. Both signal a pause, not a reversal. Volume drops during consolidation. The trade enter when price breaks above the flag or pennant on renewed volume. Set your target by projecting the flagpole's length from the breakout. These patterns let you join strong trends with low risk. Bull flags and pennants follow uptrends, bear versions follow downtrends. Wait for the breakout, don't anticipate. Volume confirmation is crucial for reliability. Use tight stops below the pattern to manage risk. Flags and pennants, fast, reliable, and perfect for swing traders seeking momentum. Practice spotting them for quick, high-probability trades. Let's move to wedge patterns for more advanced setups. Wedges are powerful patterns that signal reversals or continuations depending on context. Rising wedge, both trend lines slope up but gains shrink, usually a bearish reversal after an uptrend. The breakdown below the lower trend line is your short entry. Falling wedge, both trend lines slope down but losses shrink, typically a bullish reversal after a downtrend. Breakout above the upper trend line signals a buy. Volume often fades as the wedge forms, then surges on breakout. Wedges trap traders expecting the trend to continue. Watch for momentum shifts. Context is key. After a long trend, wedges often mean reversal. During a trend, they can mean continuation. Set targets by measuring the wedge's height and projecting from the breakout. Use wedges to spot exhaustion and time entries near major turning points. Don't trade wedges in isolation. Combine with trend and volume analysis. Rising and falling wedges. Advanced, but highly rewarding for swing traders. Practice reading the squeeze for early entries. Next, let's look at the simplest consolidation pattern, the rectangle. The rectangle or trading range is the market's pause button. Price bounces between parallel support and resistance. It's a sign of indecision. Buyers and sellers are evenly matched. After an uptrend, it can mean accumulation. After a downtrend, distribution. The longer the range, the bigger the breakout. Two ways to trade: wait for a breakout above resistance, buy, or below support, sell short. Look for a strong candle and volume spike to confirm the breakout. Alternatively, trade the range, buy at support, sell at resistance, but use tight stops. Set targets by measuring the box's height and projecting from the breakout. Rectangles are simple but powerful for swing traders. They let you profit from both breakouts and sideways action. Always confirm with volume to avoid fakeouts. Use rectangles to position for the next big move. Practice identifying them for reliable setups. The rectangle, straightforward, versatile, and a must-have in your trading toolkit. Let's wrap up with some final tips. That's your crash course on the most powerful swing trading chart patterns. From cup and handle to head and shoulders, triangles, flags, wedges, and rectangles. You now have a full toolkit. Remember, patterns aren't magic, but they give you a real statistical edge. Combine them with volume, support, resistance, and trend analysis for best results. Practice spotting these on charts to build your skills. Drop your favorite pattern in the comments, and don't forget to like and subscribe for more trading deep dives. Thanks for watching. See you in the next one.